labor, direct labor, how much? 25,000. Direct labor, 25,000. Ladies and gentlemen, the next one is variable overheads. Variable overheads, we have 25,000. 25,000. No, variable overheads is 12,500. Variable overheads, 12,500. We have fixed overheads, 10,000. Fixed overheads, 10,000. Giving us a total of 97,500. Giving us a total of 97,500. And then they have given us the budgeted selling price. We have here the budgeted the selling price, budgeted selling price is $10 per unit. $10 per unit, full stop there. $10 per unit, full stop there. $10 per unit, full stop there. And then they are telling us, ladies and gentlemen, that at the end of the year, the following costs had been incurred for the actual production of 12,000 units. So we have the actual materials, actual labor, variable overheads, fixed overheads. The actual sales were 12,000 units for 122,000. The actual sales were 12,000 for $122,000. So they want us to prepare a flexible budget. They want us to prepare a flexed or a flexible budget. So start by telling us straight away there that a flexed budget is a budget that is prepared on the basis of actual output. So any budget which is prepared on the basis of the actual output is called a flexible or a flexed budget or a flexed budget. To flex is to change. We are changing our original budget to be similar, or rather original budget to mirror the actual production. So ladies and gentlemen, listen to me very well. Whenever you are told here to prepare a flexible budget, what will you do? The first thing that you will do is to give us the original budget. The first thing that you will do is to come and give us the original budget. And I want to change this slightly to be able to give you the original budget using here. The board is not visible. Let me do something. Is it visible now? So a good question there. They're asking whether flexible budget is in our syllabus. Yes, it is there. If you look at your past papers all over, flexible budget is all over there. You know, you should be guided by your syllabus and your past paper questions. You should be guided by those two things: your syllabus file and the past paper. So once I do this, I'll be able to take you to your past papers, and I want to believe you guys at the end of the day, you'll be able to appreciate. That this budget, flexible, it's important we happen to understand them and understand them well. So thank you very much. Now here we are. So when you give me this kind of budgetary information and you want me to flex your budget, the first thing that I will do is to prepare the original budget. And this original budget basically is a profit and what here somebody is a profit and loss account, which at the end of the day here, we need to give our examiner a scenario and tell this examiner whether we have a profit or what here, a loss. So how do we get to do our profit statement? We normally take revenue minus cost. Revenue minus cost. And if you allow me, I would want to delete these two things here. The two things here. And then please, I will come and fix the sales revenue here. I will come and fix the sales revenue. Now, my great student, how do we normally get sales revenue? To get sales revenue, we normally take price times quantity sold. To get sales revenue, we normally take price times what here? Quantity sold. To get sales revenue, we take selling price times the quantity sold. So you can see here that the selling price is what here, somebody? Is 10 times the quantity sold. Quantity sold, ladies and gentlemen, quantity sold. In this particular case, given that we are doing a budget, we had a quantity that we budgeted to sell. The units that I deleted up here. And we said up here that the quantity sold or to be sold is what here is 10,000. So can somebody give me the sales revenue? How much money am I expecting to make out of the budgeted units of 10,000? Somebody talk to me. 10 times 10,000 gives me what figure, somebody? 10 times 10,000 gives me what figure, somebody? 10 times 10,000, quite easy, but I just wanted to see whether we are following 100,000, whether it's a way of getting feedback. So in this case here, sales revenue is 100,000. And then now we have, ladies and gentlemen, our expenses here. Our expenses, which are totaling to 97,500, which are totaling to 97,500. So then could you kindly come and subtract for you to give us the profit. Come and subtract for you to give us the profit. Subtract for you to give us the profit. Subtract for you to give us profit. Come and subtract here for you to give us profit. So profit is revenue minus the total cost. Total cost. So we have this being our total cost. So we have revenue minus our total cost, which will give us how much in form of profit? Which will give us how much in form of profit, ladies and gentlemen? This will give us how much in form of profit, ladies and gentlemen? Na ngoja nyinyi mnipatie profit jameni. Kitambo mlikuwa mnaongea sana, siku hizi mbona muongei sana? Profit itakuja 2,000 what here? 500. So the profit is 2,500 like that. And then I'll come and create by the side here. I'll come and create a flexed budget by the side. Please conserve your space because later on we shall be having a table, a column there for actual. So come and give us the flexed budget. Flexed budget. So remember, by definition, we said a flexed budget is a budget that is prepared on the basis of the actual output. On the basis of the actual output. So in short, for us to get a flexed budget, we normally take what we call the original budget. Very easy. Original budget. We normally take the original budget multiplied by the flexing ratio. Multiplied by the flexing ratio. I think we normally take, ladies and gentlemen, the original budget multiplied by the flexing ratio. Multiplied by the flexing ratio. So anytime they want us to flex a budget, we'll be taking the original budget multiplied by who? The flexing ratio. The flexing ratio. multiplied by the flexing ratio, 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 multiplied by the flexing ratio. So the question is, how do I get this flexing ratio? How do I get this flexing ratio? To get flexing ratio, I will be taking the actual output. Actual output divided by budgeted output. Divided by budgeted output. Andika mpaka hapo kwanza. To get, in this case, ladies and gentlemen, the flexing ratio, we normally take the actual output divided by the budgeted output. Actual output divided by the budgeted output. Now, ladies and gentlemen, the actual output, if you read this particular question down there, if you read this particular question that we have on our WhatsApp, I want to believe you guys got it there on the WhatsApp. They told us at the end of the year, the following costs had been incurred for the actual production of 12,000 units. Actual production of 12,000 units. Meaning that the actual output is 12,000 and the budgeted output which we had up there, the budgeted output was 10,000 shillings, or rather 10,000 units. So could you kindly give us this ratio, the flexing ratio? What is 12,000 divided by 10,000? 12,000 divided by 10,000 gives us what figure? This is something that everybody will be very happy at the end. It's the easiest topic. The easiest topic. So somebody here called Millicent gives me a figure of 1 point what here? 1 point. Millicent gives me a figure of 1.2. 1.2. And that is it. So to flex my budget, I'll be taking the figures that we have here multiplied by this flexing ratio. So we have here this 100,000 times 1.2. We have direct materials 50,000 times 1.2. You multiply this with the flexing ratio times 1.2. Direct materials, we have to flex this one. Then we have variable overheads. We have to flex this one by multiplying it with 1.2. And then, ladies and gentlemen, lastly, we don't flex fixed costs. We don't flex fixed expenses. Fixed expenses are not flexible. These are not flexible. If I were you, I would have written these somewhere there in my mother tongue, that we don't flex fixed overheads. We only flex variable items, like sales. Sales revenue is a variable item because the more the units we sell, ladies and gentlemen, the more we will realize as sales. So I can see that sales revenue is dependent on the number of units here that we do what here, the number of units that we sell. The number of units we sell. So ladies and gentlemen, what is 100,000 times 1.2? Give me a figure. 100,000 times 1.2, I'm dependent on you 100%. I'm dependent on you 100%. Even the slightest computations, I'll not be able to do them because I have you as my children. So please, 100,000 times 1.2, what figure are we able to see there? Somebody called Tina. Tina says it is 120,000. How about these direct materials? So direct materials, what do we have here, somebody? 60,000 from Millicent, 60,000, and then we have direct labor, 25,000 times 1.2, which will give us what figure? $25,000 times 1.2. Thank you very much. I can see Cecilia. I can see James Mwangi. Yeah. So somebody tells me, James Mwangi tells me 25,000 times 1.2 is 30,000. is 30,000. And then last, ladies and gentlemen, we have 12,500 times 1.2. This one here will give us what figure? 12,500 times 1.2, 15,000. So then what figure do you think will I put here for fixed overheads? For fixed overheads, what figure do you think should I charge? 10,000. Thank you and thank you very much. So please come and add up everything for you to be able to give us the total cost. You add up everything for you to be able to give us the total cost. You add up everything, 60, 30, 15, 10, for you to be able to give us the total cost, what we have there. Somebody is giving me a figure of 115,000. Thank you and thank you very much. So 115,000. So then could you kindly subtract 120,000 minus 115,000? What figure of profit are you going to get? Of course, I know the answer, but generally, I would want to see whether you're connecting them. 5,000. Thank you and thank you very much. So that is the end of the flexible or flexed what year budget. That is the end. But now remember, this examiner also wants us, after you've done the flexible budget, this examiner wants us to do something else there that is a bit funny. Prepare a flexed budget for the actual activity for the year. That we have done. But now number 2, they want us to calculate the variances between the actual and the flexed budget. Meaning, ladies and gentlemen, that we must come here and create a column of actual P&L. The actual profit and loss account. So actual profit and loss account, I'm only picking the figures that they are given. Actual profit and loss account haina stress. Unakuja kunaangalia the actual sales. Down there, is anybody who is able to see the actual sales down there kabisa? Actual sales ni ngapi down there kabisa? Actual sales. Is anybody who is able to see the actual sales? Not units, not sales units, but actual sales in terms of money. Thank you very much for trying. Tina. Yeah, 122,000. So you book here, sales revenue is 122,000. And then now we have the actual direct materials, 60,000. Actual direct materials, 60,000. Direct labor, 28,500. Then we have the next one is variable overheads, 15,000. 15,000. Then the last one, fixed overheads, they have given us a figure of 11,000. And then, ladies and gentlemen, we can see the cost. The cost here is 114,500. The cost is 114,500. So if you take 122,000 minus 114,500, what profit are we going to get? What profit are we going to get, somebody? What profit are we going to get? $7,500. 7,500. 7,500. That is the profit. So please write up to there as I fix my camera a little bit. I twist it a little bit so that we can be able to see the other side of the road. So now I would want us to measure our variances, and they have told us to measure our variance between what and what. Have you subtracted that wrong way? Because 122 minus 140, just try again, you see. 122,000 minus 114,500, for sure you'll get 7,500. Yeah, at least you've seen your mistake. So come and create a column here of what here? Variances. Variances. So basically variances are what here? These are differences. Variances are differences. Differences we are subtracting normally. So you take 120,000 minus 122,000. So what is the difference here? The difference that I have here is 2,000. But now you need to tell me, 2,000, is it adverse or favorable? Is this 2,000 adverse or favorable? Is 2,000 adverse or favorable? Yeah, most of them are saying adverse. I have Connie saying favorable. Look at this. Ladies and gentlemen. We had budgeted to make 120,000, but we ended up actually making more. We made more. So in terms of sales revenue, if the actual sales is more than the budgeted, then we can't complain. So then this automatically gives us what here? Favorable variance. My students have forgotten our variances where we say that when you are subtracting and you happen to get negative for sales variances are exceptional. Come to material 60 and 60, that gives us a what here, somebody? A dash. The next thing is 30,000 minus 28,500. 30,000 minus 28,500 will give us what figure? $30,000 minus 28,500 will give us what figure, my great friends? 30,000 minus 28,500. 1,500, and I can see when Millicent has gone ahead to tell us that this thing is adverse. So we have 1,500 adverse. Adverse, let's see whether it is adverse for sure. Let's see. You know, here for flexible budget, you must do some reasoning. It's not like the other one that we were just subtracting. No. Here you have to reason a little bit. Like now here, for direct labor, we are prepared to pay a whole 30,000, but we paid actually we paid less. So when you pay less, does that really disadvantage you, or in this case, it puts you at a point of advantage? So here for you have always to reason a little bit. For ladies and gentlemen, for expenses, when the actual is less than the budget, then you are doing very well because we are within the budget. We've been able to save. So in this case, it's supposed to be 1,500 what here? Favorable. This is supposed to be 1,500 favorable. Sorry for that. So go to the next one, 15 and 15. That gives us what there? 0. That gives us 0. Now from ladies and gentlemen, we go to the next one, the fixed overheads. I can see 10,000 vis-a-vis 11,000. So that will give me what figure, somebody? So we have 10,000 vis-a-vis 11,000. That will give me what figure, somebody here? $1,000 from Tina. Tina says, now this time around, I am sure it is 1,000 adverse. Who else? I can see other students are able also to see the adverse. Thank you, and thank you very much. Now, having finished this, come and give us the total variance. Somebody add for us the total variance. Please add for us and give us the total variance. Add for us and give us the total variance. So Millicent gives me, you know, when you take this and this, that is 3,500 favorable. 3,500 favorable minus 1,000 adverse, that will give me 2,000 what here, 500 favorable like that. 2,500 favorable like that. Now, ladies and gentlemen, come and subtract these two. When you subtract the two, 7,500 minus 5,000, that will give us what figure, somebody? 7,500 minus 5,000 will give us 2,500. You can see that the budgeted profits here were lower as compared to the actual. The actual profits were higher. So meaning that the difference between profits is also 2,500 good things. So 2500 what here somebody favorable. 2500 favorable, which reconciles with this. Hence the explanation. James is asking, why is the fixed overheads adverse? No problem, James. James, look at this. Assuming this fixed overhead is rent, you had budgeted James to pay rent of 10,000, but you ended up actually paying 11. You ended up paying more. When you pay more, James, that cannot be favorable to you. That will be what here? Somebody adverse. That will be adverse. That will be adverse. Thank you very much. That will be adverse. Is there any other question? Kindly ask questions, because that is the end of that subtopic. Please ask questions. We want to hear a few questions here and there. Hata niuliza swali leo jamani. Nataka kuuliza swali tu mimi. So I want us to go to our past papers. Let's go to our past. Our past papers, and I would want us to do November 2017, question number 5A. November 2017, question number 5A. November 2017, question number 5A, CPA. Share the question. Can somebody take a screenshot of that question? Can somebody take a screenshot of that question and give us that question on WhatsApp? Somebody take a screenshot of that question and give us the question on WhatsApp. A student is asking there, Millicent, explain further why 7,500 minus 5,000 becomes favorable. Look at this. This is the budgeted profit you expected, 5,000. But you ended up getting more, Millicent. Will you complain or will you be happy? Millicent, talk to me. Talk to me. You are budgeting to make a profit of 5,000, but you ended up making more profit. Will that be a disadvantage to you or an advantage to you? Thank you very much. Great. So now we are doing this question that I want to believe somebody has shared on our WhatsApp group. And I'm giving you exactly 5 minutes to try the question, and then we see how far you go with it. Now, so what I'll do, first of all, I'll give them their original budget, P and L. Original budget, P and L. So I can see the sales. So sales, 840,000. Sales, 840,000. Sales, 840,000. Direct
Yeah. Is it okay now?